We've already covered up to number 3, point number 1, 2, 3, 4, 5, 6. Point number 6 of topic number 3, that is other price action patterns. So today we want to just check now, go into details to look for all these patterns. First, get to analyze the candles on the main chart. Then you look at the patterns, how we identify them. Then from there, we can cover Fibonacci ratios and harmonics and ratios. If time allows, we'll also do areas of confluence, because now area of confluence, it combines Fibonacci ratios and harmonics. So if time allows, if we can cover all this today, it will be very good for us, so that next week we are not rushed. Great, so I want to share my screen. Let's pray that today the audio works well. Hello, can you see my screen? Please confirm if you're able to see and if you can hear me. Please confirm if you can see my screen. Great, thank you. I believe Daniel can also see. Daniel, can you see the screen? Please confirm. I know you're using your phone. Sometimes phone can have a very small coverage. Daniel, please confirm. Can you see my screen? Great. I think you can now see, because my phone now can display. I'm sure your end you can also see. Beautiful. So we want to start from candlestick analysis. We discussed about how candlesticks are formed. So it's just good to try to just see them practically, how they are formed, and understand the difference between bullish candlesticks and bearish candlesticks. Sorry, my screen, hope you can, it's clear for you. I use black and white because I prefer black background. But as we said, you can always change this to what you want it to appear, depending on your preferences. So to change anything, you just right click, go to sorry. Properties, then it comes. So when under properties, so just to start for you to follow, you right click just anywhere on the screen, go to the very bottom properties. It gives you the dialog box to change whatever you want. So we can change the background to white. Hope to be clear for you. We can say white. Then we can say, you can see for background, what you want. Grid is this the crossings. You can also remove them if you don't want them to be. Then the bar up means the lining around the bullish candlesticks. Bar down, the lining around the bearish candlesticks. Then the bull candle, right now it is black, we can say green. Okay, let's pick lime. Then the bear candle, we can say red. So we go there and we say red, then you say okay, right? So that's how you change. If you want to change your, depending on the colors you're comfortable with. Hope we are all together there. So that's how it will actually look. So I'm taking time because I know I'm trying to track my phone how soon it changes to ensure we're in the same speed with the person using the phone. Because when my phone delays, I'm sure it's also delaying on the other side for the person using the phone. So that's how you change the colors on the screen, or rather on the platform, on the chart, just to be the how you want it to be. Yeah. So I hope you can see it clearly right now. So from our discussion, we saw the green candles illustrate bullish candlesticks. And it's bullish candlestick because the closing, this is the closing price. Let's look at this big green candle. So it closed, that's there. Our close is there. Okay. That is the closing price. That's why it closed, and this is where it opened. Right? So it opened here, it went up, the bulls pushed it up, and it closed it. So that's a bullish candlestick. And as you can see, it is green in color, right? Then we also look at a bullish candlestick. Sorry, a bearish candlestick. We can just use this one here. So I'll bring my text here. This is the close, and this is the open. Because for bearish candlestick, since the bears push the market down, the close is below the open. All right, you can see it opened here and it closed here. That's a bearish candlestick, or the bears push the market down. We say the bears are responsible for pushing the market down. All right, so that's, we see a bearish candlestick, right? Then we can see the wicks there. The wicks are these tails, or all the tails. You can see this one here. Let me change something so that you can see the wick clearly. I will actually make bar up, I'll make it black. The other one I'll also make it black. Now you can see the tails there. After the candle closed, there's a tail there, because so this is the high. The market came up to here, so this is the high of the market for that candlestick. So that's how the market moved. Yeah, that's how the price moved during that. Mine is H4, that is 4-hour candlestick. So during those 4 hours, when that candlestick was forming, the market came up to here, then the bears pushed it down, it closed here. So when the candlestick opened, here we have our low. The lowest the price moved to during that 4-hour duration, all right? The low is just at the very bottom of the wick. So this is the wick, or the tail, all right? Or let's just call it the tail, the tail of the candlestick, yeah? So we have the high, the closing, the opening, and the low. Then for the other one, we have the low remains the low, the high remains the high, and then this becomes our open. The market opened here, it moved down, it closed down here. That's a bearish candlestick, right? So we are going to look at other things we covered in our first class, was the uptrend and downtrend. And to look for, I try to identify so that it can be easier for us. So that is M30. Yes. This is a downtrending market. Uptrending market, it's an uptrend. I try to make it just a little bit big for us to be able to see. I don't know whether it's just my phone which is taking long to change screens, or everybody using their phone, it's taking time to change the screen. Now it has changed. So this is an uptrending market. And we said for you to identify an uptrending market, the highs get higher and the lows get higher, all right? So in this case, we want to identify our highs. So this is our high number 1. This is our high. I'll put it in red. Then we have, I'll call it H1, our high number 1. Then we have, so you go to insert, text, then you type what you want to type. So there we have our L1, okay? So from this high, this is our next high here, all right? So the highs are getting higher. The highs are getting higher. That's our H2. H2. And we have our L2 here. Okay. Then from there, remember, this one is not a new high, where my cursor is. This is just a retest. We call it a retest. When the market reaches there and it bounces back and it's just the same level with the previous high, that's a retest of the previous high. So the market has not yet made a new high. Now, where the market is right now, that's our new high, all right? So that becomes our high number 3. Our H3. Okay. So this market it's uptrending. Highs are getting higher. H2 is higher than H1. H3 is higher than H2. So lows are also getting higher. L2 is higher than L1. So our expectation is that the market will retrace, but should not come lower than L2. We expect another higher low. So our L3 should be above L2. So until the market breaches that kind of an expectation, if the market retraces, let's say it just moves down and it comes up to somewhere here, all right? And it becomes our L3. So we see now the market has changed direction because now it has formed a lower low. And you know, lower lows are for a downtrending market. But for now, our expectation is the market will reverse and form a higher low, which will be our L3. All right. So we trade with those expectations. So when the market is uptrending, we buy at the lows because you want to buy at the lowest price possible. Sorry, just a second. My phone closed. I need to close. I will not be able to follow you in case you ask a question. Give me 1 second. I bring back the screen. Sometimes these adverts really mess you up. I wish there's a way somebody can stop adverts popping up on your screen on your phone. Great. So we are saying for an uptrending market, because the bulls are in control, we look for opportunity to buy, all right? And we buy at the lows, right? Because that is the best price possible. So in this case, we'll buy here at L1, or we buy at L2. And now if we come into your screen, if you find the market where it is right now, we cannot buy at this moment. So we wait for the market to retrace maybe to somewhere here, then we buy, all right? So I'm sure you're wondering, so how will I know how deep now the market has reached the level I should be able to buy? In our next topic, you're going to see, so how do you identify how deep the market should retrace? We call it retrace. When the market moves backwards up to the lows, we call it retracement, all right? So how deep should, or a correction, the market is correcting, like taking a breather. So you ask yourself, so where do I expect the market to come up to for me to prepare to buy? So in our next topic, you're going to see how do you carry out your analysis to know where to wait for the market for you to buy, because you're saying you buy at the lows. The market is uptrending, you buy at the lows, all right? Because we expect the market to continue moving up and up. So that's for an uptrending market. So let's look at a downtrending market also. We analyze. There's just a small trend here. We look at this small one here. This is H4, so even if it is such a small one, there's a big movement. It's over a longer period of time because it's H4 time frame. So we have, I'll try to just enlarge it. Hope I won't lose. Great, still remains intact. So here for downtrending market, the highs get lower and the lows get lower because the market is moving down. Everything gets lower and lower, right? So in this case, we want to mark our highs. This is our first high, all right? H1, all right? The market moves, it moves from H1, it makes an L1 here, all right? Which is our first low after the market reversed. Okay, then the market retraces again, just makes a very small H2, which is our next high. That's our H2. Okay, then the market moves again. We'll come up to here where it made a second, another lower, that is L2, all right? So now the market is retracing again, it's correcting. So now when the market is downtrending, we look for opportunities to sell because you sell when the price is high to liquidate or to close your account when the price has gone down. So we will sell at H1, sell at H2, and sell at the H3, which is supposed to form around here, all right? So again, there's that tool we use to know where to wait for the market. How deep do we expect the market to correct for us to prepare to enter our trades? So basically that is the trends, the uptrending market and the downtrending market. For downtrending market, we look for opportunity to sell and we sell at the highs, all right? Never sell at the bottom here, all right? We sell at the highs. So we've done the candles, the trends. I want us to do support and resistance, to identify support and resistance. And we said those are our key levels we use when we are trading. You sell at resistance, you buy at support. So how do you identify them? So I just want to go straight to some and identify so that it's easier for us today. Then at your own time, look for them. Try to identify support and resistance, right? So we said for resistance, it is where the market has been moving up, but now the buyers get less inclined to continue buying, but the sellers now become more active in selling, all right? So there is a lot of battle there, and the price cannot continue moving up, all right? So we have a small region here. Remember, we said they are zones. They are zones. So we have like here we have a small support line there. You can see the market came up, hit, it bounced back. Try to go up, it hit again. Let me make it slightly larger just for your sake. But ensure it's not so huge that it confuses you to know now how far it goes, all right? So support or resistance should have at least 2 touches, at least 2 touches. But when you notice a point where the market reversed, so you expect the market when it gets to that point to slow down. So once it reverses there, already we have a second point that becomes a support zone. It's a zone to watch, all right? Remember we said when a support or resistance is broken, it becomes the other one. As in it turns, if resistance is broken, now it becomes support. When support is broken, it becomes resistance, all right? Like what we've drawn right now, it is resistance. The market, it's being resisted from going up. It bounces, it comes back. But at some point, the market managed to penetrate. You can see now the market came with a lot of force. It broke through, all right? And it went up. Then the market started to retrace. But do you notice when the market retraced, when it got here at this level, it could not continue going down. Actually, it formed a kangaroo tail. Whatever was resistance, now it is support. It is preventing the market from going further down. All right, so we get a very strong rejection, and the price continues moving up and up. All right, you see the market went up, it came down, but whatever was resistance before, right now it is support. The market gets supported, then it starts moving up again with a very strong kangaroo tail. Hope you can see it. Yeah. So even we can actually extend that, because we said the area can act as support for days, for hours, days, weeks, it just continues. So after this level, when we extend our support, we notice again the market went up, operated up there for some time, then it started coming down. Again, the same area became support again. The market could not just go through, it reversed. So what happens, let's say you sold at around here and the market has been moving down. So already there is expectation of support here. So what happens, because you're not sure that the support is going to hold or it's going to break, so you try to protect your capital, all right? Just in case the market reverses back up, you don't give back your profit, all right? So you try to adjust your trade to ensure you protect your trade, you lock in your profit. But now eventually the market managed to break through. You can see now it came with a lot of force. It managed to break through. The moment it broke through, what happens? That area became resistance. You can see now across the bearish candlesticks, the area now is holding us as resistance. The market managed to break through here, tries to go up again, but could not go through. Yeah. So when support is broken, it becomes resistance for the next, the next move. When the resistance is broken, now it acts as support for the next round of the market moving up or down. All right. So that's what we meant with it. So we expect even right now, if this market continues moving up, we expect when it gets here to slow down. All right. Even where it is struggling right now, you can see we had support the other side. Just a second. The market is here right now. Is here. What do we have on the left? Support. All right, support. So now it is being resisted. Whatever was support in the previously, currently it's acting as resistance. So you have to always have this information. You do prayer nights to be sure where do you expect the market to face resistance. So in this case, if we get a very good signal where the market is right now, it's a good opportunity to sell, because the market has been it has been moving down and down, okay? And you can see it is facing resistance, and we sell at resistance, right? So if we get a signal where the market is right now, we go ahead and sell for that particular instrument, all right? So that's about support and resistance. But before we go to the other patterns, let me just highlight a few things to you about this, the whole chart. We talked about the time frames. When you look up here, we have M1, that is 1 minute. What it means is these candles are forming every 1 minute, all right? When minute starts, candle starts forming. When that minute lapses, that candle just closes. So this is a 1 minute time frame chart, all right? So you change as you wish. Next, we have M5. M5 is the 5 minute candlestick. M15, just like that. That's where we have the time frames up to 1 month, all right? So you just select as you, with the time frame you're comfortable. But remember, we said even if you are using 5 minute time frame, it's good to get to know what are the bigger time frames saying, all right? So that you're able to ensure that you're in sync with also the bigger time frame. Especially if you want to enter a trade to hold for some time. Then we have what we call the market watch. On your extreme left, we have the pairs, where we have the pairs of the instruments, okay? So we have them there. So you select, if you want to add a pair to your window, you just click on it. Like I don't have USDJPY, I will click on it. It gets highlighted in blue. I right click, then I say chart window, and it gets imported or rather transferred to my chart, to my window, okay? Then when it comes, it's always in the form of a bar chart, all right? Then up there, we have a lot of icons. You can see now the bar chart is highlighted. Next to it is the candlesticks. So I will click on candlesticks to change to candlesticks, and then I magnify it a bit so that it is very clear, all right? But the moment you put always in bar chart, so you need to come and click on candlesticks, then you magnify, you enlarge it to be visible, all right? Then we have on the market watch, you might find not all the instruments are displayed. Not all the pairs are displayed. So what you do, if there's a pair you want to put on your chart window, like yours, once you download, you'll find like 4 of them, maybe Euro USD, GBP USD, USD CHF, but you may not find something like XAU USD, that is gold. Yeah, XAU USD is gold. You may not find Wall Street 30, those are indices. SP 500, those are indices. So if you want to load them to your chart, they will not be also anywhere on your market watch. So you will come, you click on view, all right? Once you click view, go to symbols, click on symbols, all right? So whatever you want to display, you find them here. If it is gold, XAU USD, you enlarge spot metals, all right? Then you select. XAG USD, that is silver. It's even shown there, silver versus silver, that is spot. Then you have XAR EUR, gold versus euro. XAR USD, gold versus, sorry, gold spot. Of course, it's always versus USD. That's why they have just put it like that. If you want indices, yeah, like the SP 500, the Wall Street 30, you go to CFD indexes, all right? Then you open, all right? So I should have shown you. Okay, let me just pick one here. So if you want to load them, like the case of spot metals, let me go back there. All of them I have, that's why they highlighted. I'll go for what I don't have. CFD indexes, all right? Then I want to load, let me look for NASDAQ. Let me just say Japan 225. I will click on it and then click on show. On that box on the right, it is okay. If it is hidden, when it's not highlighted, it's actually the hide is actually the one which is highlighted, sorry. But if it's not on your symbols, when you click on it, the word show gets highlighted. So I click on show. All right, I click on show. You see now it has been highlighted to mean it has been transported to my symbols, to my market watch, that is. So that is JAP 225. I will close, then I'll come here and scroll down and look for JAP 225. It's now here. Then I can click on it, right click, say chart window. All right, so that's how you load them to your chart window. So if they are not on the market watch, you just go to view, symbols, just the same procedure, symbols, open. If it is majors, yeah, like the majors we discussed in our discussion, like me, I don't have GBP CAD. You can see when it is like this. When it's not, I click on it, show gets highlighted, okay? So I say show. The moment I say show, it's added to the market watch. Then if I want to put my window to my to my chart, I just go for it, click on it, right click, say chart window, all right? If I want to remove them one by one, I just click close, I remove that one. I don't need it in my chart, I close. But I just like to operate with very few myself, so I don't operate so many pairs, all right? So I remove what I don't need. That's how you work with the market watch. I don't think there's anything else I needed to show you in this one. When you want to, okay, let's discuss orders. We discussed about market execution, all right? So when you want to place an order, like right now, I want to sell this particular instrument. You click on new, all right? You click on new. You can see here we have type market execution. And we said market execution is where you buy or sell at the current market price, at the current price displayed on the screen. You can see these two prices here, and they are changing as as the market moves up and down, all right? So remember we say there is the bid price and ask price. And we say the bid price is if you're selling. If I click sell by market, my order will be filled at the bid price. If I click buy by market, my order will be filled at the asking price, because I want to buy. So whoever is selling to me is asking for this price. Okay, it's the price they are asking for to sell to you that particular instrument. So for market execution, you just click on sell and your order gets filled just like that. All right. Now, if you're on ECN like me, before I go there, let me just show you something else. We discussed about stop loss. You can see the stop loss, take profit, all right? So if you want to buy right now, you can actually set up your stop loss. You say you've already done your analysis and you want to put your stop loss at, let's say 26,500. So you come here, because if you're selling, your stop loss must be higher than the selling price. Then take profit should be somewhere below. All right, so I take my take profit as 2,600. Right? 26,000, sorry. So I will click sell. Mine will refuse, invalid, because I'm on ECN accounts. ECN you have to modify later. But if you're on standard or ECN 0 or those are the, but it doesn't make any difference. They are all the same. So what you do for my case, once I sell without putting the stop loss and take profit, I'll come and click on my order. Then I right click. Then I say modify. Where you have modify or delete, I click on it. Now then it allows me to put my stop loss, 26,600. And my take profit as 26,000. Right? Then I say, okay. You see that it has captured, this is my stop loss. This is the price at which I sold at. This is my stop loss, my take profit, and this is the current price. This will keep on changing. Then this is the commission. The swap depends on the pair, or it really doesn't matter much. Swaps usually negligible for people like us who do small volume trades. It mostly occurs when you hold a trade overnight. It will attract a swap. And swap will depend on interest differentials between the pairs you're holding, right? So like, if a pair like USD JPY, if I sell, well, that is details, but I can explain to you later. I don't want to confuse it right now, but I'll explain later what swap is all about, but usually negligible for us. If you buy small volumes, it's very little. But if you buy like 5 lots, 10 lots, then you can find swap going into hundreds, because every night you hold it over, it continues charging. So it can either be positive in your favor or negative, okay? So it depends on the pair you're holding, whether it's a sell or it's a buy. But that I can explain to you later once you go deeper into Forex, okay? So that's how you enter your trades. Let's say you want to enter a pending entry, all right? You want to just instruct the market. So here under market execution, you will say pending order, all right? So when you say pending order, it gives you the options of the types of pending order you want to put. Remember we discussed about buy limit. When you click on that drop down, it displays to you all the types of orders, all right? So you can say buy limit, sell limit, buy stop or sell stop. So at your own time practice, just try to read how we define them, then you practice to place them and see what's gonna happen. That's how you place them. Whatever you want, you click on it, then you put the price at which. Remember, it will not give you any option of the price, because you're the one to decide which price do you want to place your pending order at, because it will only be triggered once the market reaches to that particular price. Okay, so that's how you place your pending orders. Great. I think that's it about educating you about the chart. But if anything comes up, you can always ask if there's anything you need any clarification on. Just try to interact with the chat more to learn more. Then also, if you get any question, you can always ask. We are going to discuss. Great. So now we'll go to the other types of patterns. We discussed about the double tops, reversal patterns. double bottoms, head and shoulder, and inverse head and shoulder. So we want to see which we can identify now. We just can identify just a few, then from there at your own time, you look for the others. I think I'd seen one here. But it's not, it is a minor one. That was a minor one. Just a small one we can identify here, although it is not very clear. It has a lot of other things. Let me see if we can get a clearer one. Well, I can show you something in the meantime. I want to show you. Can you allow me to restore it back to where it was? When it's like this, I can't see clearly. Then I can show you some of the things I wanted to. Background. That's how my charts were. This is the color I'm usually comfortable with. So I want to show you, actually here we have a very clear double top strengthened by a catalyst, all right? So I want to show this double top. That's the first peak. Sorry, let me see if I can bring it in the middle a bit for you to see. That's the first peak. Sorry. That's the second peak, okay? That's a double top. When you look at the second peak, sorry, I can't enlarge. Once I enlarge, it's going to get hidden because it's quite some days back. This was printed on 3rd of October 2018. But that's a double top. But on the second top, there is a very strong kangaroo tail, bearish kangaroo tail. You can see a very long tail and a small body. So if this when you wake up the following morning, you find something like this, it is just very good to go ahead and you sell. Let the market give you an opportunity, then you sell. And you can see when the market reversed, how deep it went. Actually, it went for how many? Before it reversed, it was at 29.40. It went up to, well, within 2 months. It reached bottom on 24th of December. I remember this date was really going down. Went up to 23.50. That's the lowest. From 29, that's over 400 or 4,000. That's a lot of money. If somebody just sold and held there, I will not tell you how much money you'd have made. But of course, as we are intra-trade, we cannot hold for months. Those big people, oh, sorry, somebody has typed something. Oh, sorry, let me try to hold nicely. Clear in audio or is not visible? Francis, let me know which is not clear. You cannot see it clearly or you cannot hear me. You mentioned it's not that clear. Most likely, not visible. I thought so because it's very small. If I enlarge right now, you won't see. But I will show you another one elsewhere, okay? I'll definitely show you. But that's an example of a double top with a kangaroo tail. But there's still another kangaroo tail I will show you. Kangaroo tails are almost everywhere. We'll see them so oftenly. Let me return where it was. I think there was one on the XAU-USD. Can you see this? Very strong kangaroo tail here. Although the body is bearish, I want to show you this kangaroo tail. But this came in as a continuation pattern because you saw it can also come as a continuation. That's a bullish kangaroo tail. When the tail is from the bottom, all right, the tail is below. It shows the bulls push the market, they reject this price, they push the market back up. You can see the body is so tiny. Although the body is bearish, but the length of the other characteristics are already fulfilled. So you can comfortably come in and buy. And you can see how the market has moved after that kangaroo tail was printed. Okay? This happens a lot, especially also in gold. Yeah? Gold, I've seen it happens a lot. Even this kind of rejection, all right? Anytime you see price get reject like this, look for opportunity to buy. These kind of long tails, they tell you the strength of the bulls pushing the market up. If it's the other direction, the strength of the bears pushing the market down. When you see kind of a rejection, position yourself to buy when you get the opportunity. Let me see if I can get any other double top or double bottom. Yeah, this can actually be a double top. But they are always, depending on the time you're trading, even especially 5 minutes, because I use 5 minutes a lot. In my trading, I mostly use 5 minutes, then I track with 1 minute. But I still do a glance on the bigger time frames. So I will say, that's a good example of a double top. And actually, you can see the second top is slightly lower than the previous one, all right? So that gives us a moolah, all right? So if you sold here, the market breaks the neck and it came down. Although it still tried to go back again before it went down further. So you'll always see them without actually looking for them. As long as you're looking within the time frame you trade, they'll always be there automatically. Then you can always position yourself to enter a trade. So you can now, at your own time, look for the double bottom, head and shoulder. I think I'd seen an inverse head and shoulder somewhere. Let me see if I'll see it right now. But this was also not very clear. Sometimes when you're looking for them is when you don't see them. But when you're trading, you will just see them. I don't know. Sorry, Euro USD, it sometimes refuses to draw. I'm not sure why. It actually refused to draw that one. But it's fine. If I get more chance, I just take a photo and share on the WhatsApp for us to discuss more. But basically, that's how we look at the charts. How we study the charts, you draw your patterns, or you identify them and you position yourself to buy or to sell. Any question before we move to the next? You can see this. Let me remove this. I show you. Another very strong bearish kangaroo tail on a weekly chart. Remember, we say they appear on all time frames. Can you see that? Very strong bearish kangaroo tail. So many times what I like to do, every morning before I start trading, of course, okay, I start a bit late around 10 when the London market opens, I will first check on daily, how did it close, all right? On Monday, I want to check on weekly, how did the charts close for the pairs I trade, all right? Like if you came on a Monday, this is gold, the USD. You came on that Monday last week, then you found last week, the other week's candle was such a strong bearish candle, such a strong kangaroo tail, then you position yourself to sell. And you can see it really moved down before it started going up this week again, all right? So you just, every morning you can check how did the previous day's candlestick close. Does it give you any signal? No signal, fine. Go to H4, go to H1. Then you narrow down to the time frame you trade. As I mentioned, mostly I use M5, M1, and M15, yeah, to enter my trades. But I still have to use the bigger time frames to give me some bearing of how the market is going, where the market is going. If the market is bearish, I will use 5 minutes, but look for opportunity to sell. If the market is bullish, I will use the 5 minutes, but use the opportunity to buy. All right, so that's how we do it. Great. This one, you can see we saw that resistance very strong. This is 1 minute candlestick, very strong resistance. The market was unable to go through, so we sold, and you can see we're already in some small profit because you said you sell at resistance. You sell at resistance, right? Now there, you start getting your profits. You let it run. So, sorry, my phone has closed again. I want to be able to follow in case you ask a question. So now from here, I'll stop screen sharing. Then now we go back and look at the next topic. Yeah? But you can always ask question anytime. Feel free to ask any question. Karibu Kare, I can see you've already joined us. Lydia, I think you're typing something. Let me wait for you to finish typing before we go to the next. Explain what is happening to your order below. I can see negative and positive. All right. Let me go back to screen sharing then. Sorry, I've already moved from there. Sorry. Let me go back to screen sharing. Then I can show you. When you look at that order, you've mentioned, you can see, please explain what is happening to your order below. I can see negative and positive. Yeah, you can see it is still moving. What is happening? I mentioned the type is a sell. Yeah, I've taken a sell or a short position. Size is the size of the lot size. Remember we said we can have, this is a mini lot. You can go, but some instruments will not allow you to go below a mini lot. That is mostly the indexes, or rather indices, the Wall Street 30 and SP5. The minimum you can enter those ones is 0.1, a mini lot. But the rest, you can go like USD, you can, all the others, you can do something like, let me pick this. Order, you can do 0.01, that's a micro lot. Remember you said the lot is broken down further to mini lot and a micro lot, so that you can be able to participate without any struggle. So all the other pairs, you can actually do a micro lot, 0.02, 0.03, 0.0 something, all right? Or a mini lot, 0.1, or a whole lot, or you can have a 1, 2, 3, depending on what your account can accommodate, all right? So those are, the volume is the lot size, the size of your trade, okay? So I want to encourage, of course, we'll do risk. We'll also discuss that further under risk, but as you start practice the smaller sizes, so that you also condition your mind yourself to be able to trade what your account can accommodate. Great. Then the symbol is the kind of pair, the instrument you are trading. Price is the price at which you entered your trade at. Like I saw that 26,484. SL is the stop loss. My stop loss at 26,600. TP is my take profit. Once the price reaches here, the trade will close at a profit. All right. Then the price, the other price here is the current price. This keeps on changing. As it goes up, it goes up also. So you can see it is changing all the time, because it's the prevailing price. All right. And you see this one is different. There's a slight difference between this and this one because of what you call the spread. This is how we say now this is where main breakers. Of course, the spread for indexes is a little bit higher. It's not like for the other currencies, for the Forex pairs. So this price will always be slightly different, but it's something like gold. If you sell gold, the spread is zero. Yeah, so most of the other pairs, the spread is very small, but for the indexes, it's a little bit bigger, all right? Like in this case, you can see this price is slightly bigger or rather higher than the current price here on the chart. And that difference is what we call the spread, okay? Then we have commission. So this commission is a charge to the broker. Over and above the spread, they also charge a commission, right? Which is, it depends on also on the instrument you're trading. So the profit, you can see initially when we were looking at it, here it was profit, here it was a loss. Because at the bottom here where it is in gray, it is the net. The net is this one minus the commission, this one minus all the charges for the broker, all right? If I had something for the swap, it will also be either deducted or added depending on whether it's a positive or a negative, okay? So this is whatever is here is different from here because of the commission. So this is -4. So when you add, this becomes -1.04. That's how this is now the net difference. Whether it's a positive or a negative after you take care of the broker's commissions. So this is now my net profit or my net loss after taking care of the broker's commissions. If I close right now, this is what will go to my account, a negative. Okay? So hope I answered you, Lydia, sorry. Great, great. So now we can go to the next topic. Of course, we'll also come here as to illustrate whatever we're going to discuss in the next topic. We'll also do a lot of screen sharing. Now we go to Fibonacci. So remember we mentioned if the market is downtrending, you look for opportunities to sell. If the market is uptrending, you look for opportunities to buy. And you buy at the lows because you expect the market to move up. If you're selling, you sell at the highs, expecting the market to move down. So you ask yourself, so how will I know how high the market will go for me to wait for the price to come there for me to sell? So one of the tools we use to know how deep the market is likely to reverse is Fibonacci retracement or Fibonacci tool, Fibonacci ratios. We also use it to determine where to place our take profit. Yeah, when you use what we call the Fibonacci extensions. So let's just see what it's all about. Fibonacci retracement. And you say a retracement is a correction that occurs during a prevailing trend. So it is that correction which actually forms the highs and the lows, all right? If the market is downtrending, the correction forms the highs, all right? It goes down, it moves up, forms another high, it goes, so that are the corrections. So it's a correction that occurs during a prevailing trend. It is often regarded as a period of rest before a trend continues on its original direction. It is important to note that at the point where the trend starts changing, the market can either reverse, change direction completely, or just rest and carry on its original direction. So what we aim to do with the Fibonacci tool is to identify when it is a reversal and when it is a retracement. Okay? So we only trade retracements as it is in the direction of the trend. Yes, remember what we said? If the market is uptrending, or look for opportunity to buy and buy at the lows when the market has retraced. If the market is downtrending, look for opportunity to sell and sell when the market has retraced to a high, then you sell. You may have heard the expression used, the trend is your friend. And for our method of trading, this is 100% true. So that's how we say we're trading as per our expectation. Because if the market is uptrending, we expect the market to reverse, make a higher low, higher low, then it continue moving up. It retraces, make another higher low, then continues moving up. So we buy at those lows, okay? Because we want to move with the trend. So a Fibonacci retracement is a term used in technical analysis that refers to areas of support. Price stops going lower, or resistance, price stops going higher. Fibonacci retracement levels use horizontal lines to indicate areas of support or resistance at the key Fibonacci levels before the trend continues in the original direction. Basically, Fibonacci has a history, yeah? Somebody somewhere discovered how some of these numbers works, and it has an history which is not really so important. So we'll only focus on the ratios we use in trend. But if on the history, I have some reports somewhere I can still send to read, but it's really not necessary. Just master the ratios we need to use, how to draw it, and you'll be good to go. Okay? So these levels are created by drawing a trend line between the high and low, and then dividing the vertical distance by the key Fibonacci ratios of 23.6, 38.2, 50%, 61.8. Well, this should not scare you. If you don't like maths, don't ask yourself, well, this is already inbuilt in the tool. You have just to draw it. It generates the ratios for you. Then now you make your decision. So you don't need any calculation. Don't be scared. Everything is already inbuilt in the tool. I just want to show you how to pick the tool, how to draw it, and how to make decisions. Okay? So Fibonacci retracement levels are static prices that do not change, unlike moving averages. The static nature of the price levels allows for quick and easy identification. This allows traders and investors to anticipate and react prudently when the price levels are tested. So this is an example of a Fibonacci. Yeah? You can see it. So when the market is downtrending, okay, we pick from the highest high, from the high to low, okay? So we will draw our Fibonacci for a downtrending market from high to low. Downtrending market, Fibonacci gives people issues, but I'm sure you'll get it. So you draw, if it's a downtrending market, you place your cursor high, drag it down, release at the low here. Then the ratios are generated here. You can see we have 23.6%, 38.2%, 50, and 61. All right, they're automatically generated. So we say these are the areas, the ratios areas, the 23, the 38, the 50, and the 61, and the 17 somewhere here, are the areas we expect the market to reverse, make a high, then come back and resume the original trend of downtrending. So this gives us an indication of where we expect the market to reverse, to what level. So again, you'll ask yourself, now there are already so many of them, so how do I know which is which? Again, we are going to see as we get deep into our analysis, okay? But one of the key ratios is 61.8, yeah, the golden ratio. If the market reverses and gives you a signal, that is one of the best opportunities to take a trade at Fibonacci 61.8. Again, you're saying we'll see deeper. As we go deeper, we'll see how do we make those decisions. But basically, it's one of the tools which helps us to know how deep or where do we position ourselves, yeah, to enter our trades. Where do we wait for the price? If you've come in right now and you found the market was somewhere here, you found the market here. Now it is starting to reverse. So you ask yourself, so where do I wait here? Do I wait here? Do I wait here? Okay. So these ratios already give you an indication of where the market is likely to react, because they are like support levels. Not just like, but even when you draw, somehow they align themselves with areas of support. Okay. You can see we have support here. Sorry, resistance here, where we have Fibonacci 61.8. We have some support here, okay, support here, where Fibonacci 50 came in. Again, that asserts support again here, support here. So those lines, there's a way they just align themselves, they appear where there is support. Actually, when they appear, they coincide with a support or resistance level. Then that gives you a stronger confirmation for you to prepare yourself to enter a trade. Now, when the market signals you, all right, because that's what we call a confluence of pressures and support. All right. So that's how we draw the Fibonacci. Sorry. No. What did I do? It's okay. Let me just leave them. It gave me some red warning. I thought you want to close everything. But basically, that's how we draw Fibonacci. But you're going to see in the chart how we draw them and how we analyze them, okay? So Fibonacci retracement is a very popular tool used by many technical traders to help identify strategic places for transactions to be placed. Target prices, that is the take profit, or stop losses, right? It also helps us to know where to place your stop loss and your take profit. After a significant price movement up or down, the new support and resistance levels are often at or near these lines. And we've actually seen that. This is a resistance. It is near 61.8. A support zone, it's near 51.8. No? So they somehow just get aligned in a way once you draw it. So the most significant Fibonacci retracement level to watch for is the 0.618, which is the 61.8%. This is the inverse of the golden ratio, 1.618. So this, the 61.8% retracement level, tends to be the maximum pullback zone, where fear climaxes as the final sellers throw in the towel and bargain hunters rush into the stock to resume the uptrend. Okay, that's why I said when market reaches 61 and you see there is also support or resistance area, and then the market signals you. Again, we say that this market is operated by human beings. They are not robots. We all think the same. We all know how the market will behave at 61. So more buyers, more sellers will come in here. Okay, so even as we join in there and we all push the market back down to resume the downtrend. Okay, to resume the downtrend. So there's that kind of understanding that when it gets there, if it was retracing up, the buyer started giving up and the bearers coming and start pushing the market down. And if it was going up, the opposite happens. On downwards, the 61.8 price level should be where the final buyers are exhausted as sellers take the opportunity to unload their positions and short. And short sellers jump off the fence to push down the price and resume the downtrend. Some traders prefer to wait for 2 to 3 candles. Okay, it depends on your. Sometimes you just try to make it suit you. What do I want to see for me to be sure to get a stronger signal? The market is resuming the old trend. All right. So you're saying some traders will wait for 2 to 3 candlesticks closes above or below a Fibonacci retracement level to confirm support or resistance before placing a trade. Okay. So I want us to go back to our chart sharing. Right now, you may not really get what it's saying, but once you start drawing, you will just get it, what it is telling us. If you look at you can see everything in is positive because this one is higher than the commission. The profit here is 0.8, commission 0.64, our net is 0.16, okay? So now we go to Fibonacci ratios. Let me see what I can use, which can be a little bit clearer for you to see. I will minimize this. Now, this market here, it reversed, now it's moving up. So this is our low. Our low, it's hidden. Then this is our high. Okay, so for an uptrending market, which is going up, we draw our Fibonacci from low to high. The Fibonacci tool, it's on your chart. You'd see somewhere with dotted lines and a letter F at the corner of the dotted lines. When you place your cursor, it tells you draw Fibonacci. Just click on it, then just carry it. You just click and release, then you come and place at the low, hold your cursor, then you drag it up, okay, up to the H. So you can see it has generated these numbers, 38.2, 50.0. It has generated these numbers. We have 38, we have 50, 61. So these are the Fibonacci ratios. They give us an indication of how deep the market is likely to come before it resumes the original trend. Okay, so we read at 23 in the other one, but mine I have removed. 23 is already around here, and I find it's too shallow for me to make a decision. So I decided to remove it and rely on 38, 50, 61, and 76. All right. So when the market reaches one of these ratios, yeah, we have to make a decision for what we expect. But there are areas which actually give you almost an indication of, you can just decide, I will only take a trade once the market comes here. Like if you notice, when the market reached 61, actually there's a very clear formation of an inverse head and shoulder. An inverse head and shoulder. Let me show you. You can see that. So it also, and this is a 1 hour. It also forms within your Fibonacci, giving you a confirmation it is time to end. Remember, we said these patterns, there can also be a continuation patterns, all right, to tell us the market is going to continue moving up. Also, when you look to the left, there was support zone here. Here we have support. So maybe you'd have also drawn and realized this support coincides with ratio 50. So you're like, if the market gives me a signal at ratio 50, I will enter. Remember, you're doing all this analysis when the market is somewhere here, right? You've just come in and you found the market is somewhere here where there is this arrow, yeah, at H. You found the market there. So you are waiting for the market to reverse, because we cannot buy here. We don't buy at the high, we buy at the lows, okay? So you want to find that. So where do I position myself to buy, all right? So you draw your Fibonacci first, then you check other critical areas, like we have support area or a resistance zone. So this was resistance. So we expected to play support, right? So that also helps us to know where to wait for the market, all right? So we are saying at 50, I will be good enough. I can enter there. I can enter at 50. So we wait until the market gives us a signal. So if you bought here, it will still be fine. The market comes here at 50, it will start reversing, like it's going up, you buy, it's fine. When you buy here, your stop loss should always be below the Fibonacci 100. Your stop loss will be somewhere here. Okay. So you buy at this level, your stop loss is here. So even if the market struggles to go, you know it's still within you. So sometimes people feel like this stop loss is so far away, you try to bring it so close. So sometimes you can struggle your trade such that it cannot even move. So you have to try to ensure you don't struggle your trade. Give it room to breathe. because market will always retrace, will always move up and down. So you have to ensure you give it enough space to breathe. And one of those spaces is by placing it here. This was our first low because our expectation is that the market is uptrending. So the next low has to be higher than this. So we don't expect the market to come and take away this low. Of course, that can still happen. But when that happens, we say the expectation has failed. But we always trade as per our expectation. If it fails, it's fine. It's not our fault that it failed. We made our analysis, we made a decision, and then we took a trade, okay? So if you buy when the market reaches 50 and you see the market is reversing, you place your stop loss here and you relax, all right? I will show you where to place your take profit in our next class. So let the market operate, and eventually the market breaks through and starts going up. The moment the market goes past H1, all right, our high here, sorry. When the market crosses our zero line, now we say we move our stop loss to break even, okay? You bring it somewhere, you lock in your profit. Let's say the market is now currently here, okay? So you move your SL. We bought at here. This was our buy. Okay, we bought here. We bought here and our stop loss was here. Initially, the stop loss was here. So the market moves, it comes to here, the market is here. We move our stop loss to slightly above structure. So our stop loss is, now we put it there. So remember, if we bought, it means now we have locked in some profit because we bought here and our stop loss is here. If the market reverses and starts moving down, from here it comes and triggers our stop loss, at least we'll be in profit, all right? Because we bought here, all right? So that's what I meant by locking in profit, all right? The moment the market crosses the zero line of your Fibonacci or goes above the previous high, then you can slightly move your stop loss to break even, to ensure your trade is covered. Now your trade becomes a risk-free trade. You know you cannot close at a loss. At least you've locked in some profit, okay? So as the market continues moving and moving, you continue moving your stop loss. Now you are trailing the market. You are trailing it. And you're going to see how do you trail the market, okay? So you continue locking in more profit, ensuring your trade is protected. And also if the market reverses, you don't give back so much profit. Now imagine the market is where it is right now. If you let your stop loss remain here, then the market decides to reverse again all the way here. So it means you've given back all this profit, which is not right, okay? So as the market moves up, you continue moving your stop loss. You can do it manually or you set up a trailing stop, all right? So you can continue moving manually. The market moves, you move it again. To set up a trailing stop, we said the system must be on throughout. Otherwise, your trailing stop will just stop somewhere, become a normal stop loss, and sit down and wait for the price to come back, okay? So to set up a trailing stop, you've entered your trade the way it is here. Then you click on it, right click, go to trailing stop, all right? Then you click. Right now, it will not allow me because I can say not trail. You only trail after your trade has gone into profit and reasonable profit, okay? Then if it's 40 points, I'll say 40 points. You see now it has already changed. Actually, it does not change my stop loss because it still can't trail until I'm in a good profit. My stop loss has become my trailing stop. But once the trade goes into profit, I've told it 20 points. So every time it moves further, this one it changes by 40 points, following the process. It goes up by 40 points, following the price, okay? This is our trade. So if it allows us today, if this can reach something like 50, then this will change to 61 because we've told it to trail at 40 points, be 40 points behind the price, all right? But if the price starts moving back, it stops and waits for the price because it cannot move backwards. It only moves forwards to follow the price. When the price starts moving back, it stops and waits for the price to come. So it keeps an equidistant at 40 points as long as the price is moving forward. If the price starts coming back, it stops. If the price hits it, now your trade is closed at that particular price. Okay, so that's how we do it. So you can trail manually. Yeah, you continue moving your stop loss, or if you're too busy, you set up a trailing stop, either 20 points or 40 points, whichever you're comfortable with. All right, so that's how we draw our Fibonacci tool. That's for an uptrending market, but we do the same for downtrending market. Okay, hope it's not getting complicated. I love Fibonacci tools. At first, when I began Forex, I hated because I could not understand how it works, but I can't trade without Fibonacci. I can't trade. And if you're a price action person who deals with price instead of indicators, you need Fibonacci. And it's the best tool you ever want to learn how it works in Forex. It's very helpful. Okay? So we want to look for a downtrending market. But basically, let me see, I think Euro USD, yes. Yeah, here we can just draw, though it's a little bit small. So in this case, this is our high. And this is our low. Okay, so remember the other one was uptrending. We drew from down going up. For downtrending, you draw from up going down. So you go pick your Fibonacci tool, click on it, move your cursor, click on where there is H, drag it down to where we have L1. All right, you've drawn your Fibonacci. Okay, so that helps us to know how far is the market going to reverse before it comes back down. And as you can see, if you can see, let me try to see if it will allow me to enlarge. Yes. You can see here where we got Fibo 50. We had a very strong kangaroo tail. That's a very good signal for us to sell, right? So we go ahead and sell here. So what you do, once you draw a Fibonacci, you wait at the Fibonacci ratios to see a signal, but you can also draw your support line or resistance lines to also know which ones are stronger, which are the stronger points to sell or to buy, okay? So in this case, we'll buy at Fibonacci 50, okay? Sorry, we are selling. The market is downtrending, so we sell. So we sell here. Our stop loss, we put it up here. Our SL, okay? We put it there. So we sell. So the moment the market crosses, it crosses the zero line here. We move our stop loss, lock in some profit, because this market can reverse, okay? So even if it reverses and takes you away, that is fine. That is fine, okay? So this becomes, the moment it makes another low here, market came and made a lower low, our L2. Okay, so if it reverses, then it hits your stop loss, it is fine. It is fine. At least you're out at some profit. This was our H2. So the market reverses. But right now, although we're expecting sorry, what did I do here now? Remember, the market is downtrending. We're expecting lower highs and lower lows. But now from L2, the market has made a high which is higher than the previous high. Okay, this becomes our H3. At this level, we say our expect. Why do I leave it like that? don't know, I forget to delete that T. H3 is higher than H2. So our expectation was for a H3 which is lower because the market is downtrending, the highs are getting lower. But now H3 is higher than H2. So we say our expectation has failed. So in our thinking, the market should be reversing. So at this level, you just do nothing until the market gives you a clear indication. If anything, you look for opportunity to buy. Okay, at this level, you look for actually they've even bought around here. Yeah, although the market again went down and made another low. So there are moments the market just refused to cooperate, which is fine. We said nobody controls this market, it just behaves as it wants, but you always work with expectation. Okay. So the moment it makes a higher high, already the market is tuning itself to reversing to an uptrending market. So you look for opportunities to buy but not to sell. Okay. So sometimes you can have a series of broken expectations. It is fine. It is not your fault. You've done your analysis. You've done it right. Okay. So that's where risk management comes in. All right. And you're going to see how do we take care of all this using our risk management skills. Okay. So that's how we draw Fibonacci ratios. And that's how we place trades using our Fibonacci. Now we place our stop losses. Right. So at your own time, this is the assignment before our next class on Monday evening. Please just draw and send a photo on the WhatsApp group. You don't have to do much. You don't have to show us what is where. Just drawing a Fibonacci, okay, for an uptrending market, downtrending market. Also for the patterns, if you see one, mark it and send a photo there, all right? At least do something before our next class on Monday evening. Do a Fibonacci and you share with us, okay? So we may not be able to cover ratios and harmonics right now. I'm sure you're already having so much, having interacted with the platform for the first time today. We will cover that on Monday because you're going to combine that now that with our Fibonacci. But I want you to think first. So before our next class on Monday at 7 p.m., please do those assignments. Draw a Fibonacci and take a photo, share on the WhatsApp group. Identify a pattern, share on the WhatsApp group. Okay? Any question before we end the class? Then on Monday, you can do ratios and harmonics and areas of confluence, which will combine all of them. Any question, any clarification before I move from this screen sharing? Great. If there is no question, I will leave my trade running. We'll see whether it will be there on Monday, or it will be taken away in whichever direction. Let's leave it running so that we can see what happens on Monday. So if there is no question, I think we'll end the class there. We are good, eh? Great. If there's no question, I think we just end the class. You can drop any question in the WhatsApp group, but do the assignment before next class on Monday evening. Do the assignments and then you drop them there. Okay, have a good night and a nice weekend.